Welcome back here with Money, 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 and this is the gold special on our festive series. So the question is, if you're actually looking at investing in gold, mind you, not just buying jewelry, but real investment in gold, then what are the best avenues? Should you be thinking of sovereign gold bonds? Should you be thinking of gold ETFs? Let's ask our experts. Now, Chirag, of course, you are closely associated with the functioning of an ETF. So tell us, I mean, has the arrival of this new instrument, the sovereign gold bond, has it changed the market in any way?
Yeah, see, this year has been a very different year than usually we have. Demand has been significantly lower because of there were strikes by the jeweler community, there were real rates moving positive. So we are actually in a different ball game together.
But you're talking about the physical demand for gold.
Yeah. So overall demand for gold is same. Be it physical, only people choose different avenues to make their investment choices, and that is how it differs. So overall it is guided by the overall demand for gold. So sovereign gold bond has been a new offering by government, and really it has seen good response, largely on account of the additional income that people can make on their gold investments. But there are certain drawbacks of that form of investment as well. One is it's not available on tap. Whenever I want, I cannot just go and buy. I can buy, but I have to go to the exchange, not to the government, not to the issuing entity. And if you see on the exchange, there are liquidity issues. The bid-ask spreads are wide, liquidity is lower, and that can have investors step back from that form of buying. Okay, so let me also get in Harsh on this. So Harsh, on these two important aspects of ease of investing and liquidity, on-tap investing and liquidity, sovereign gold bonds sound phenomenal because over and above the capital appreciation that you might have, you also get an interest, right? The government of India is willing to pay you an interest. But what about the points that Chirag just raised? Liquidity and investing whenever you want.
So like any other investment, there are four criteria, right? Risk, return, liquidity, and I would add a fourth in the context of India, ease of investment, right? Clearly return-wise gold bond scores. I mean, you get an interest instead of having to pay a fee to somebody. So I think clearly return-wise it scores. Risk remains the same. I mean, you're taking a risk. Okay, it's slightly different. In an ETF, you're taking a risk backed by physical gold that the fund house holds, whereas in a gold bond, you're taking a risk on the government of India's promise that they will match the price of gold.
But it's sovereign, right? So
it's
typically,
sovereign, yes.
Sovereign is almost considered risk-free.
Well, worldwide, as I'm sure Chirag will say, government promises are weighed just like anybody else's promises.
We might not trust politicians, but when it comes to governments, we end up trusting governments a lot more.
And I think our government, as a government, has done enough. We have never defaulted. So I think sovereign, so risk-wise, there is very little to choose. That brings you to liquidity and ease of investment. Liquidity, clearly in an ETF, the liquidity is well defined. I mean, you go to the market, sell. You want to purchase, you go to the market, purchase. On a gold bond, you can on paper do the same. Right now the market is not that
gold
well
bonds
developed.
Have started trading very recently on the exchanges, right?
Absolutely.
So how is that working out?
So as he says, the liquidity may not be the best that you want, but I suspect that's a matter of time, which leaves us with ease of investment, I think. And I think on ease of investment, again, there is another instrument that we have not considered, which is a gold fund.
Right.
And a gold fund in turn would invest in the ETF of its own fund house or maybe some other ETF.
Right.
In terms of ease of investment, gold fund is the best.
Why do you say that?
Because I can do a SIP. Now, very difficult to do a SIP in an ETF or a gold bond, though is not available on tap, right? But in a gold fund, I can invest low amounts. I can invest a fixed amount every month, right? So all that ease of investment actually is the best in gold fund, is the most expensive because there is a cost of gold fund, there is a cost of the ETF, and the interest element is very low because they are only allowed a certain portion.
So Chirag, explain the cost to us so that as investors one is aware of,
Sure.
what you need to obviously pay to the asset management company because they are obviously, providing you the service. So if you're talking about a gold fund or a gold ETF, what sort of cost should we be aware of?
See, gold ETFs are generally priced at expense of about 0.9 to 1% kind of range. So that is largely going towards storing, safekeeping, insurance of gold. Like for quantum gold fund, we also have terrorism insurance. So if anything goes in terms of a terrorist activity that happens and gold gets destroyed, it's still covered by the insurance.
Okay.
So that's kind of safety. We don't want to compromise even a bit on the safety aspect.
So 0.9 to 1% of your total investment would be going towards the fee.
Yeah, and I was sharing with him, as the size of the gold ETFs increases over time, these costs are bound to come down.
Okay.
So today you
How
might
does
be
it
paying...
compare with, let's say, the international benchmarks that we see? International gold ETFs that we talk about.
International gold ETFs are around 0.4%, but they don't take insurance.
Okay.
So Indian gold ETFs take insurance, and like us, I don't know about the other guys, but we go a step forward and ensure that no compromises are made on the insurance that we have taken.
Okay.
Now coming to the gold funds that are there, which invest in the gold ETFs, so the gold funds pay an additional expense for managing that scheme. So it is over and above the gold ETF.
Because they're investing in the ETF.
That costs are also coming down as the size of these funds, because nothing really happens in managing those funds. Whatever flows I get, I invest in that gold ETF straight away. No calls to be there. So for that purpose, we charge a very nominal fee now at 0.1%. So all that you are paying additional is 0.1%. The advantage that you get there, when you buy as a retail person, your broker may charge an exorbitant brokerage, like about 0.5%. Whereas we as asset management companies pay about 12 bips. 12 basis points. So there's a vast difference between, though the 10 basis additional, but there's a vast difference when you invest. So that really saves you. So I agree with Harsh that gold funds are, I think, the best way, because one can do SIPs of like 500 rupees a month.
And there's no minimum investable cap, or there's no minimum investment amount, which is the case
as
in
low as 500.
Yeah, which is the case in gold bonds, right? Because I think the minimum is 1 gram.
Minimum is 2 grams. I think minimum is 2 grams. So we're talking about
and the liquidity of those bonds can come into question because each tranche of theirs is listed separately. So there has to be liquidity of each of the tranches in which you have invested, which is going to be very cumbersome.
Are the tranches not intertradable?
No.
That's a very important point then.
So right now liquidity clearly is challenged. It's a new instrument, but I suspect going forward,
as the market
give
improves,
it 6 months, 9 months. I think that difference should vanish. Logically, that should not remain.
Okay, so let's take a break on that note. On the other side, this conversation continues. Which instrument should you invest in? Will taxation prove to be the real clincher? Which of these instruments is most tax efficient? Find out after the break.